Welcome to Yadnya Investment Academy. Today we are going to talk about dividend stripping. To understand dividend stripping, there are three things you need to understand. First, that dividend stripping is only relevant in case of equity mutual funds, and that too in the short term, that is where the investment duration is less than 1 year. Second, in case of equity mutual funds where the investment duration is less than 1 year, dividends can result into a capital loss. We'll see an example of how this exactly happens. And after understanding 1 and 2, you can understand how large dividends resulting into large capital loss can be misused. And that exactly is what is dividend stripping. Let us first understand how dividend stripping is relevant only in case of equity mutual funds. Now, whatever dividends you get in case of equity mutual funds are completely tax-free for the investor as well as the mutual fund. Short-term capital gains, that is the gains you make on equity mutual funds for an investment duration less than 1 year, are taxed at 15% flat. So in this duration, that is an investment duration of less than 1 year, whatever dividends you get are completely tax-free. In case of debt mutual fund, the dividend is tax-free for the investor, but the mutual fund has to pay a dividend distribution tax on the dividend amount, and it is 28.84%. Now this is taken from profits the mutual fund generates for you, and it is close to the highest tax bracket. So it is beneficial only in the case where you are in the tax bracket of 30%, and that too in the short term. That is when your investment duration is lesser than 3 years. Because after completion of 3 years, if you redeem your debt investments, they are taxed at 20%, that too after indexation. Now understand how a capital loss is incurred. Let us take an example to understand this. Let us say you invested into an equity mutual fund when the NAV of the mutual fund was 100. That is, if you invested 100 rupees into this particular mutual fund, at this point in time, you would get 1 unit of that particular mutual fund. After being invested for 2 months, the NAV of the fund rises to 110. Here, the mutual fund house decides to announce a dividend of 20 rupees per unit. After dividend distribution, the NAV of the mutual fund comes down by the amount of dividend distributed. So the new NAV is 90 rupees. That is 110 minus 20. New NAV is 90 rupees. And here, if you decide to redeem your investment, you would make a capital loss of rupees 10 per unit. That is your investment amount minus your redemption amount. So here, you've pocketed a dividend of 20 rupees per unit, which is completely tax-free. At the same time, you've incurred a capital loss which could be adjusted against a capital gain made somewhere else. But to claim this capital loss, as per income tax rules, you should have invested into the mutual fund at least 3 months before dividend record date, or you should redeem your investments at least 9 months after dividend record date. Dividend record date is the date when the mutual fund house determines who are its investors and to whom the dividend has to be given away. Now, a dividend is announced 5 days prior to dividend record date. In this time frame, a lot of investors invest into mutual fund to get the tax-free dividend as well as incur capital loss. But in that scenario too, you cannot redeem your investments before completion of 9 months from the dividend record date. Now that you understand that dividend stripping is only relevant in case of equity mutual funds, and that too in the short term, and you also understand how capital loss is incurred, let us move towards understanding what exactly is dividend stripping. Now this tax benefit on dividends of equity mutual funds can be misused in the short term. Let us see how. Now the usual dividend amount is around 10% of the NAV price. At times mutual fund houses announce larger dividends which are more than 15% of the NAV price. This is done in 2 scenarios. Scenario number 1, where the mutual fund manager wants to distribute the profits made on the mutual fund portfolio so as to reduce the impact of market correction on the portfolio in an already heated market. Scenario number 2. Now it is alleged that some mutual fund houses, when announcing larger dividends, leak this information to high net worth individuals so as to attract large asset under management. Now this large dividend, which results into large capital loss, can be utilized by high net worth individuals to offset capital gains made elsewhere. So friends, hope we've been able to explain what is dividend stripping in this video. Thanks for watching this one. Watch this space for more such topics. Friends, a lot of you request us certain topics to be covered. Some of them we've already covered. If you want to see if Yadnya has a video on the keyword you're looking for, go on the homepage of our channel on YouTube and utilize the search within the channel, not the YouTube search, and all the videos related to your keyword would be listed. Hope you utilize this option to explore our channel. See you in another video. Until then, keep learning. Happy investing.